Good morning and welcome to the Killik & Co market update. It's been a quiet week in the market this week. In fact, over the past 6 days, the S&P 500 and index level has moved about 0.25%, which makes it the quietest period in 4 years. One hot topic of discussion these days is, of course, inflation. Is it transitory or is it here to stay? How transitory is actually transitory? In reality, it's really too early to tell for sure, but we've certainly seen higher input costs courtesy of raw material prices and supply scarcity. So much so that there are multiple reports of inventory hoarding, with some producers opting to overbuy and pay up for materials and storage to avoid turning away new orders. All of this, of course, puts further pressure on already strained supply chains. On a recent conference call, the CEO of listed engine manufacturer in the US, Cummins, said that you name it and we've got a shortage on it. Whirlpool, the appliance manufacturer, currently producing products based on what parts are available as opposed to what products are in demand. And the CEO there has said that they see supply constraints being elevated for a sustained period. Monster Drinks, for example, are dealing with aluminium can shortages, and even European haulage companies have reported they're struggling to keep up with haulage demand. A number of somewhat unforeseeable events have compounded some of the issues. Droughts have caused problems for crop supply. Global shipping has been heavily impacted by the tanker incident in the Suez Canal a couple of months ago. And more recently, hackers shut down the largest fuel line in the US, which pushed gas prices above $3 a gallon for the first time since 2014. The general undertone is that companies will not be able to absorb higher cost bases forever, and at some point they'll need to pass these on to consumers. Now, strong brands will be better positioned to do this than some of their weaker counterparts. Something that caught my eye this week was food inflation. So the UN published its Food and Agricultural Food Price Index for the month of May, which recorded the highest reading since 2011. The May increase was the largest month-on-month gain since October 2010. It's risen almost 40% over the same period last year. It is now 7.6% off its all-time highs. Food inflation is an important part of the global CPI basket, and it represents a reasonable share, CPI being the Consumer Price Index, which is a measure of inflation. The Food and Agricultural Organization, or the FAO, has a really nifty tool called the FAO Data Lab, and they publish loads of interesting data, and amongst it statistics for food price changes by country. So since February 2020, food prices in the UK have risen 2.8%, 3.5% in the US. Emerging markets, however, are witnessing higher rates of food inflation. Rates in Mexico and India are exceeding 8%, and Brazil's running at over 14%. So while wage growth will be top of mind for central banks of advanced economies, emerging markets may struggle to overlook rising food costs. Now, a number of emerging market central banks have kept interest rates at record lows despite consumer prices exceeding inflation targets. Further food inflation could be something that changes the outlook, which potentially risks premature tightening of policy before recoveries fully take hold. You'll have no doubt seen that the UK government amended the COVID travel list last night and will downgrade Portugal from the green list to the amber list on Tuesday. Many were indeed hoping for more countries to be added to the green list in time for a holiday season, but have sadly been left disappointed. The news is a blow to an airline and travel sector that's been desperate to get back on its feet after 15 months of travel restrictions. So shares of IAG, EasyJet, TUI and Jet2 all took a knock and were down between 4.5% and 5.4% yesterday. Now, those may sound like fairly big moves, and in normal times they would be. But to highlight some of the volatility in the sector throughout the pandemic, I took a closer look at the frequency of large daily price moves in those 4 companies over the past year. I defined a large price move as any daily return in excess of 5% in either direction, so share price up or down 5%. I'm not sure what you might have expected, but I was somewhat surprised to find that around 1 in 5 trading days over the past year saw losses or gains in excess of 5%. Just to put some context around that number, taking IAG, for example, which is the owner of British Airways, in the previous 4 years, so pre-pandemic, the share saw moves of that magnitude in only 1 in 25 trading days. So interestingly, on balance, there have been a high proportion of positive large move days than there have been negative, with 56% of 5% days to the upside and 44% to the downside. This may, of course, be somewhat expected given the general positive tone surrounding the reopening trade. So against the current backdrop of continued travel uncertainties, it seems as though some of the volatility in the sector may be here to stay for a while longer. It's really quiet again on the corporate front next week, so enjoy the weekend and we'll see you again next Friday.